Uranium Energy Corp, one of only 12 uranium producers in the world. UEC trades on the New York Stock Exchange. They have more than doubled their in-ground uranium resource over the past 2 years. They've also become one of only 6 uranium producers in the United States. Led by Amir Adnani, who has been ranked as one of the top resource CEOs by Casey Research, Amir has attracted major investors like Rick Rule of Sprott Asset Management, Li Ka-shing, the richest man in Asia, and institutions such as Vanguard and BlackRock. Learn more about Uranium Energy Corp at uraniumenergy.com or by calling 866-748-1030. Greetings and thank you for joining us at FutureMoneyTrends.com. I'm here with Dennis Miller at the Casey Summit in San Antonio, Texas. He writes the letter for retirees or people who are near retirement, and it's called Miller's Money Forever. Dennis, thank you for joining us.
Well, thank you for asking me. I appreciate it.
All right, Dennis, your letter is probably the most important because honestly, even if you're not nearing retirement, these unprecedented times, I don't think it's a time to take a lot of risks. And Casey Research, of course, a lot of people learn about it from libertarian, values, gold and silver, all things that are important to all of us, sound money. But then you can't live on 100% gold. And you also don't want to live on 100% mining stocks. So what is your letter advising people to do who are near retirement or at retirement to preserve their wealth during basically an economy that lives in a constant crisis?
That's a really good question. Ask any retiree, and they will tell you of this experience. Envision somebody, national sales manager, has been very successful in his career. All of a sudden, he cashes out with a lump sum payout on his 401k, $1 million, whatever. And all of a sudden, he looks at this and has this feeling in the pit of his stomach. My gosh, that money's got to last me the rest of my life. I'm not trained for this. I don't know what to do, okay? And that when you're investing retirement money, the whole theme behind our conference is investing in a crisis time. When you're investing retirement money, you're always investing as though a crisis might be coming because you don't have that option of a do-over. Yeah. So that your position limits, your allocations, your whole mindset of how you approach investing your money is totally different.
Do you specifically focus on stocks for income, or do you look at real estate, bonds, other assets that people aren't aware of?
Well, yes, let me back up first and go back to part of the problem, and then I can show you what we do it, because the answer is all of the above, but with a lot of caveats. One of the things that we saw this week at the conference was, I believe it was Grant Williams talked about the war on savers. And I've used that term a couple of times, and people said, is that kind of extreme? And, Bernanke was quoted as saying, the policies of the Federal Reserve are requiring seniors and savers to put a whole lot more of their capital at risk than they're accustomed to. And he referred to the seniors and savers as collateral damage. If that's not a war term, I don't know what is.
Yeah.
Wow. And that when you couple that, there was a quote in the Malden book, Code Red, that everybody knows the market's on thin ice, and everybody thinks they can get out of the market ahead of the other guy. They can get through the door, if you will. Well, I don't think we're going to necessarily get through the door first. Our goal in investing that retirement money, and I'll talk to you about the allocations in a second, is to get through that door whole so that we can live to fight another day. Too many of my friends took 40 and 50% hits in 07, and that's the real collateral damage. It's not the loss of interest income that you would have gotten from the CDs. It's the collateral damage you could experience if you had a sudden downturn in the stocks or the bond market where you had to exit your position quickly. Now, with that, do we go into the market? Yes. We only put 50% of our retirement portfolio in the market with a whole bunch of caveats, stop losses, position limits, low correlation, internationalization, so that it's giving us all those kinds of safety measures.
Do your stocks that you guys are buying, do they cater to the Casey crowd in the sense that are you buying Coca-Cola or are you buying a natural energy company or something like that?
The Coca-Cola. As a matter of fact, we held Coca-Cola for a while and it didn't meet our standards. But what we're looking for in the stock are appreciations, dividend, inflation protection. The more international it is, the better.
Yeah.
Okay. Plus one other thing, the ability to exit quickly. Now, many of the Casey stocks are very thinly traded. Okay, and if you had to exit a big position quickly, it would be difficult.
Yeah, no, you'd probably move the market cap to somebody.
Yeah, you'd move the market. Exactly.
Oftentimes in the junior mining stocks, people ask me why they move, a significant amount. It's like, who knows? Maybe somebody got divorced and they had to sell 10 grand. I mean, you don't know. What about the other 50%?
Okay, 30% of it is in investments which we were looking for yield and then appreciation. Okay, and we're investing in a lot of places where, you have your business development corporations and your master limited partnership. For example, one of our investments is Sunoco. Well, we're up over 50% in Sunoco, but we bought it for yield, but we'll take the appreciation.
Yeah.
We're involved now. We have a business development corporation. Convertible bond fund. Thank you for your patience. That gives you 2/3 of the upside protection of stock, but 1/3 of the downside risk. And we're up 22% in that, plus we're getting a nice yield.
Yeah.
And so that's the income first. Then the other 20% goes into what you and I would have called the cash accounts. Mm-hmm. Well, right now my brokerage firm pays me 1/100th of 1%.
Yeah.
So $10,000 invested gives you $1 a year in interest. Whoopee. So we're saying there are investments that you can put in there that can be quickly converted to cash. Interestingly enough, we are in short-term bond funds, 2 to 3 years out. Very low duration, paying 3-4%, but it's making a contribution. So if the bond market collapsed, what's the worst thing we would do? We would hold on to them to maturity.
Yeah, this is probably, I would assume, for younger people, but I'm not a retirement expert. A lot of Austrian economists and people who are worried about the economy are starting to use whole life policies because you have that cash value and guaranteed return. Is that something that you would consider for safety?
We have written a series of reports with annuities, and I have worked. I don't sell these for a living. Okay. Yeah. Investing in insurance is, to me, a misnomer. The only way to make a life insurance policy a good investment is to die ahead of your mortality. The only way to make an annuity a good investment is to outlive your mortality. So that basically when you're looking at investing in life insurance policies, you are paying them just as though you would a fund manager to invest your money. And those fees can become very, very significant. So that you have to look at that as compared to other products, because insurance policies are a transfer of risk. So there are a lot of better opportunities. Now, actually, there are some circumstances where I would suggest that retirees buy an annuity, but very limited as a portion of your portfolio. Don't think you can sit there and buy annuities and buy a retirement plan and you never have to worry again. Have any kind of inflation, you'll realize you made a mistake.
In closing, I want to ask you a question, just kind of if a Lehman Brothers event happened tomorrow morning, mm-hmm. where are your portfolios Friday? Are triggers being set to exit these? Absolutely.
Let me just give you a quick example. On the stock side, no more than 5% goes into any individual position. 20% trailing stop loss max. Might be 10, might be 15. Now, of course, if you invested on day one and on day two a Lehman Brothers event happened, okay, if you're going to lose 20% but only half is in the market, you'd have a 10% overall loss. Mm-hmm. So there are safeguards and protection built in, but that's well beyond the worst case, because many of the things that we're invested in are not correlated directly to the market, which would buy us time to make decisions. Many of the stocks that we're invested in are the kind that would come back quickly. And okay, just don't sell, just keep getting the nice dividends and you'll be fine.
Yeah.
So worst case, we would probably lose 12 to 15%. I have friends in 2007 that retired with that 401k like we talked about that lost 40 and 50%. They'd have been ecstatic with 10%. You live to fight another day.
Yeah, I'm sure a lot of people who bought silver and gold are wishing they had a stop loss.
Oh, yes, yeah. And on the silver and gold side, I believe there's also what we call the core portfolio, which is the basis of that, and that everybody should have that core portfolio as their base, even before they go into the kind of stuff we're in. Because if we have that Armageddon event, it's that core portfolio, when gold hits $10,000 an ounce, that is going to really help us live to fight another day. But that's the kind of thing, and you see it at the Casey Company. I don't care what happens. I'm not selling my gold. They bought it for a different reason.
Yeah, exactly. Dennis, thank you so much for your time.
Appreciate it. Thank you.